My name is Johnny Bailey. I lead business education for Amazon's Undiscovered Business and Small Business Accelerator, and I'll be your moderator for today. Building a business is a proven way to solve problems, help people, and ascend economically. However, it's very difficult to be an entrepreneur. Entrepreneurship is a very lonely journey and requires an unsettling appetite for risk. And when it comes to financial success, simply put, you need money to make money. And the reality is, just because you need money doesn't make it easy to find money. The topic of today's session is unlocking capital, where we'll discuss strategies to navigate the funding landscape. With me today, I have two distinguished panelists who will help us provide insights so you all can succeed in your entrepreneurial journey. Our first panelist, who will offer the perspective of a successful founder, we have the head of Amazon's Undiscovered and Small Business Accelerator. Please welcome to the stage, Ms. Danielle Surrency-Jones. Our second panelist, who will offer the perspective of a successful investor, we have the Chief Strategic and Operations Officer at Trident. Please welcome to the stage, Mr. Aaron Betrou.
Thank you.
Thank you both for being here.
Thank you for having us.
Thank you for having us.
Really excited to have this conversation with you. And before we really jump into the questions, I would love for you all to add some more color to your background. I'll throw it to you, Danielle, and then we'll go to Aaron next.
Yeah, so Danielle Surrency-Jones, and you know, if I had to summarize who I am, I'm a builder. I love taking things from dirt, seeing them explode, of course, and to benefit others, and that's what I've done with my career. Almost 2 decades with Fortune 100 and 500 companies in the medical device space, working cross-functionally across sales, marketing, and operations. Then becoming an entrepreneur like you and starting my own business. I am an innovator at heart, right? I really love creating. And I started 2 businesses. One, of course, was not successful. And the other, I was able to make it to a tender offer as well as a strategic merger. And then I decided to take on this incredible assignment with Amazon, with the Undiscovered and Small Business Accelerator, which includes our $150 million commitment to the Black Business Accelerator, where we want to make sure that we create sustainable models that include education, marketing, technology, in order to unlock discoverability. So I do believe this is my assignment at Amazon to make sure all small businesses like you can thrive and succeed.
Thank you. Over to you, Aaron.
Well, pleasure to meet everyone. Aaron Betrou. My background is a little bit atypical. I started out as an entrepreneur that actually, after a number of years in finance and management consulting, an entrepreneur in social enterprises. I started a nonprofit that did innovative financing in sub-Saharan Africa, doing receivables financing for foreign governments. And then I became a policy wonk at the Milken Institute, where I was pushing financial policy initiatives. So an entrepreneur innovating on financial policy that led to how do we deploy capital that makes things, essentially, how do you use financial markets, products, services to build meaningful lives in the US? And then my current day job is at Trident. Trident is a buyout private equity fund based out of New York, but we invest in small businesses in all 50 states. We help entrepreneurs that essentially identify and effectively grow them and scale for the benefit of not just our investors, but we have a thesis around making sure that we do well while doing good in communities. And I'm also fortunate to be an advisory board member for Danielle's BBA.
Impressive. Thank you.
Thank you, Johnny.
So let's dive into our session agenda. We plan to cover 3 important topics. What you'll see here on screen is 1, identifying the right funding sources, evaluating your capital needs, and calculating risk and measuring ROI. If you have questions during our session, I implore you to scan the QR code here, submit or vote on questions that you see there, and we'll do our best to answer your questions at the end. Also, this session is being recorded and will be available on demand. So let's dive in. A quote here you'll see from our founder and executive chairman, Jeff Bezos, says, "Be stubborn on vision, but flexible on details." And in this case, the vision is how your product can help people or how big and great you believe your company can be. The details are how you will find the funding to make it all happen. So let's get everyone on the same page here in regards to economics. Panelists, in your opinion, why is capital and funding so important?
Oh, that's a million-dollar question, right? But it's such an easy answer. Capital is the fuel and the rocket fuel as to which our businesses grow, period. If you do not have capital to inject in your business, how will you be able to allocate funding for marketing, for your human capital, for your inventory, and other resources? So you have to have capital, and you have to have a mindset of how I'm going to inject fuel into my business in order for it to grow. And you, as a double minority-owned business, woman-owned as well as Black woman-owned business, I'll tell you, Johnny, that really this was something that kept me up at night because there are systemic barriers that I have to face every single day when you look at the margins and the statistics that tell me that less than 2% of minority-owned businesses are receiving funding. That when you look at the audits and hygiene of businesses such as ones that have the profile like mine, that there's more scrutiny, that I don't have the networks, right, in order to get the napkin that has my proposal and get it approved. Yep. So capital and getting to the right resources was super important in my journey and understanding what that looks like across the business life cycle.
Absolutely. Aaron, you want to take a stab?
Look, you can look at capital, the obvious. I can quote so many pieces of research that talk about undercapitalized businesses are the ones that never scale, never grow, never actually contribute back to their founders. There's a lot that's been written there, but the other thing to think about is that first comment that you made in terms of being stubborn on your vision. From an entrepreneur's perspective, you're probably thinking really long-term, where can this really go? And the difference between that are the resources that you put to bear, whether they be human capital resources or the fixed assets that you're gonna buy. And that capital can end up being the decision-making between how do I put this one step forward, one little piece at a time out of my own pocket, or do I actually think about how do I jump 3, 4, 5 steps forward with acquiring an asset, acquiring competition, acquiring different pieces that actually get me to the next stratosphere. And those resources, that capital, is going to be really critical in helping you reach that stubborn vision that you have.
Yeah.
And I want the audience to kind of walk away and challenge themselves. Like, if capital was not at all a factor that I can have access to it in an unlimited fashion, that's how your vision should be perceived.
Mm-hmm. So that capital is really the fuel that will launch you off the ground. And so I want to take this next question kind of at an early stage, then a scale stage when we think about the funding options, because I believe if you understand the funding options that are available to you, you can make better plans for your business.
Absolutely.
And you can avoid taking on bad debt or signing contracts that are wrong for your company. Let's talk about what funding options are available to business owners. And Danielle, maybe you can talk about the early stage, and then Aaron, you can talk about maybe a little further along in the growth stage.
Yeah. Happy to talk about the early stage because, boy, do I remember those days like it was yesterday. Those were some of the most painful days that I have ever experienced. I just got married. We just bought a house. We had a baby at the end of the year. And boy, did we give birth to another baby.
Life-
a
lifing.
business. Life was lifing, right? And so we knew we had this incredible idea. We had started with phase one, created our business plan, and we understood the market potential was $20 billion in the sporting goods space. But when we looked at what are our options, of course, based on all of those life events that I just said, in order to fuel this particular idea to take it from ideation to commercialization, we had a couple of options. And one was my 401k. Very bad decision, right? We did make that decision. And throughout the course of the next 5 years, I dumped my 401k into the business, paid double taxes. We also did a friends and family round of funding. We also did crowdfunding. What I'm telling you is my lessons, right, should help you understand that we were operating in a mode of we knew we had this incredible product and IP that we were taking to market, but strategically, from a financial, strategic capital standpoint, we didn't get someone in-house to really give us guidance on what that path should be until year 5. And so we made a lot of mistakes up front, but we learned very, very deep lessons. So yes, you can bootstrap, right? Use your own. As a matter of fact, you should use your own fuel. If you believe in your idea, it can be from your savings. It can be strategically. There are options now to take loans from your 401k for ideation, such as new business ideas. But you should be using your own fuel. But what my advice to you is, just as you have a business plan, make sure you create a plan that specifically maps out what your strategic capital journey would be. And then that will tell you in the early stages where you should be taking funding from years 1 to 5 and where you should be getting organic growth in order for your business to thrive.
So I'm hearing bootstrapping, friends and family, crowdfunding, being thoughtful about how you dip into your own nest egg. Understood. Aaron, for someone who's maybe in the growth or scale stage, what options are available there?
Well, I'm going to take it even further to the buyout stage where we play, but the way that Daniela articulated is one that I would repeat. I think for most entrepreneurs, they're thinking kind of in shorter time frames as well as kind of the long-term vision. I think the way you should be contemplating the different funding options is based off of the key milestone steps that you're going to end up having. What I mean by that is, in the beginning, yes, I'm just ideating on something. And there's a different option set that's available to you there. If you're thinking about, well, I've got this perfect idea, I need to get to a proof of concepts, product or service, there's a different set of options that are available today. When I get to actually getting something built and first set of customers to really set myself up to a bigger scale, it's a totally different group of players there. Once I get to actually cash flowing positive, there's a different group of players there. Until you get to an actual exit, there's a different group of players there. And so actually taking a step back and saying, where am I at on this journey? And who are the right partners for me to get me to that next step? And make sure that your ask is about how to bridge yourself to that next step. From an entrepreneur's perspective, you may be thinking, well, I only need the next 3 to 6 months to prove this. I will tell you from a financier's perspective, there are key things that I am looking for. And if you haven't gotten it there, I'm going to wait until you get there. And if you don't want to under ask, and that's a common principle for someone who comes from a disadvantaged background, I should not ask for too much because that is going to be harder to get.
How do we calculate how much we ask for? You know, the cost of running our business or growing our business. What do we work backwards from there?
Literally think about what it is that it's going to take to prove that next milestone. If you're saying the definition is or you've been hearing from different partners, financing sources, hey, I need you to get to X number of customers or Y number to presume the definition of a proof of concept, you should be thinking the entirety of that plus a little bit of bleed, whether it be product bleed, your margins bleed, or your customers walk away, whatever may be the case. Ask for that plus a little bit extra. You always want to ask for a little bit more. Obviously, there's going to be trade-offs, right? Somebody's going to want their pound of flesh for whatever you ask for. But I think that's the commonplace to educate yourself on what you're willing to give up for what you're going to be getting.
And I love this question because I think it connects to a step that we often want to skip. As creators, we just want to innovate and we want to launch, right? It is so important for us to step back and in our business plan, you should have a P&L. That P&L is going to be a raw P&L, but it will help you understand when you're starting your business and throughout the growth of your business, what your OpEx is, what your marketing expenses will be for your go-to-market strategy, what your expenses, of course, that are included in the OpEx. Are you going to pay yourself or not? Are you going to be a sole proprietor? Are you going to hire someone, right? Are you going to hire an agency to help you launch? So that P&L is super important. And then I'll also say one next step, your pro forma. So you should have a 5-year pro forma that really helps you understand when I go to market, I'm going to launch on Amazon. And I'm going to estimate that I'm going to reach X number of customers by launching on Amazon and selling X number of units. Then I'm going to grow my omnichannel to launch into other distribution models. That 1 to 5 year, 5 to 10 year pro forma will help you strategically and methodically think through that journey that Aaron is talking about so that you're not guesstimating, it is in black and white. And you have either a CFO from CFO Now, you have someone that is in-house that can help you with that modeling and to, again, go through that financial journey.
So having the right financial documents and that financial professional is a really great way to start on solid ground. I love that. And as we think about taking on money, whether it's at a growth start stage or even at an exit stage, I think we know that we need money to make money, but nothing is free, right? And the capital we accept comes with a trade-off, or more explicitly, a risk. So let's talk about that. What are some of the risks to consider when unlocking capital from outside sources?
Yeah, so by the show of hands, can I see how many people in the room have actually raised capital? That can be friends and family, seed round. Okay,
See a
awesome.
few hands. Okay.
So the first thing that I want the team to think about is, do I need capital? That's number one. If you don't need capital and you've done your pro forma and your business plan and it shows that organic growth and you funding your own business where you can keep 100% of your ownership is the route that you should go, I encourage you to do that, right? I did not have that luxury. So I am speaking from the group of those that raised your hand where you injected capital strategies into your model in order to grow. So when you're thinking through that, I want you to work backwards from this thought process. Who do I want sitting at the table with me to share in this incredible opportunity that you have to impact the world through your innovation? This is not about who you need. This is about who you want to sit at the table and share a piece of your idea and ownership and equity. So I'd like for you to think carefully about that when you think about angel investors. When you think about your cap table and who you want to be on that cap table. Because those people that are on that cap table, whether they're passive investors or active investors, they should be getting you into rooms that you can't get into. So when you think about one, loss of control, are you really losing the control when you are making the right decision in the beginning to de-risk you by having the right investors, right? There's something you have to give up. There's a trade-off. But there's also a pro to making the right decision for the trade-off because there's a long tail game that you're playing. There's also, of course, increased pressure, whether you're signing a safe note, a convertible note, whatever the terms are, whether there's a short-term loan or, again, you're getting an investor and going to a round, there are terms that you have to meet. And if you don't meet those terms, there are consequences that you have to pay. So again, thinking through what are my trade-offs in the loss of control and what are the terms that I'm going to create for those investors with two I would call out.
I really like that visualization exercise of who do you want there. It's starting to feel like some financial therapy today.
Who's gonna sit at your long table and share in your wealth of this incredible meal that you're creating based on your innovation?
Aaron, from the investor's perspective, what risks should we consider here?
So from an investor's perspective, I'll just share. So Trident as a buyout fund, the way that we engage in the marketplace, we work with what we call ISOPs, independent sponsor operating partners, to help identify businesses and actually are part of the trajectory of growth. And they end up actually getting a piece of the upside on the back end. Now, the ones that we work with, we like to say they have a specific subsector advantage that makes them dangerous. What do I mean by that? I mean something that is either regional, functional, or industry specific that says whatever the thing we're going to be working with them on, they actually have a rationale for how they're going to get to scale, to return money not only for our investors, but actually in a way that helps doing well while doing good. And I can tell you the number of times we've had experienced individuals, 20 years in the insurance sector, and I have this thing that I think we can go out and buy with Trident Capital, with your investors backing us, and here it is. It's in the consumer sector. Or I'm a consumer expert, and here is this other thing. And I see the passion, I see that experience, and I'm like, you got to go ahead and do it, but you're not going to get third-party capital. Now, I want you to remember what I just said. Your passion is fantastic. You should go ahead and do those things. But if you're talking about third-party capital, they're going to want to see something demonstrated. As you're less likely to go talk to a dentist to help you with your hearing, from an investor's perspective, I'm going to be looking for some of that experience. So that's the risk that I'm actually trying to calculate. And so if you're talking about preserving some of that control that Daniela was talking about, think about the demonstrated thing that makes you dangerous for that particular opportunity and lead with that when talking to a capital provider. That's a way how to mitigate the risk that Danielle is talking about. And that's the thing that helps me mitigate my risk to put my third-party capital to potentially engage with an entrepreneur or a business.
I love that, Aaron. I think yesterday when I was interviewing and moderating with Arlen Hamilton, who was homeless, who has raised a fund, $30 million for entrepreneurs. She sat on, the steps of Silicon Valley and begged until they understood what her mission was to raise money to help underrepresented founders. And she talked about the fact that you got to make sure in your presentation that you are speaking so positively about your product and knowing your space so that when you are presenting to a Trident and to an Aaron, he is, again, wanting to figure out how can I join you instead of how can I take from you to join you? Because at the end of the day, he's trying to evaluate what does he have to supplement within your business or your expertise in order to get his return. So the goal is, of course, to make sure that you have a bench of expertise and that you know your business from a very positive aspect and you've got your valuation in line in order to make sure that my friend Aaron here is not
everything she said, but I am not taking anything from you.
Is not stepping to the table with a term sheet that feels like they have to supplement more, right? based on who you are as a founder and what your go-to-market strategy and idea is.
One philosophy that I remember as an entrepreneur in my reading is the market wants your seed, not your need.
Yes.
So you gotta go bringing something to the table and not going asking or, desperately needing something. I think the trade-off is, the perspective is different when you say, hey, I'm going somewhere, would you like to come with me?
Yes.
So really good note there. And I also think having a really sound plan can essentially de-risk some of your business, right? And so how you allocate your funds or your plans to allocate your funds can be really informative to an investor or a lender. Can we talk a little bit about the difference between operational capital and growth capital and how you, Danielle, thought about those funds when you were starting your business?
Yeah, operating capital is your day-to-day capital. What do I need from day to day to make payroll, from day to day to send inventory to FBA, from month to quarter to participate in high value events such as Prime Day or seasonal and cultural growth events? That is your day-to-day operational capital. And how I thought about that, of course, is putting it in black and white, operating based on a P&L and balance sheet. Now, we're entrepreneurs. And we know at the end of the day, we do work in the business. So yes, are there going to be indicators and projections that we're going to miss? Absolutely there are. There are Fortune 100 and 500 companies and trillion-dollar market cap companies that miss projections every single day. So I don't want you to think this is a perfect formula. But if you have your pie chart that says, in order to operate my business from a day-to-day perspective based on the OpEx, the distribution channels, and what I need from a profit perspective to pay your employees, right? And to be in the black, here is what my model should be. That is putting it in very simplistic terms as when you talk about operating capital from a day-to-day perspective. I'll let Aaron talk about growth.
Well, I want to kind of double down on that. You mentioned some of the resources or fulfillment channels that Amazon, FBA. Can you talk about some of I think we'd be remiss if we don't talk about the amazing resources and benefits that we offer here at Amazon. Could you touch on some of the other resources that are available to help our selling partners succeed?
Yes. So when we of course, I've got the team, of course, that is sitting in the room, and we've had a full day of Accelerate just talking about our resources. And I'm proud of the work that we're doing through our Black Business Accelerator. So when I think about one of the resources, we have a growth accelerator, and we have really identified one community, which is the Black community, to really understand pain points across other small businesses. So resources, of course, from an account management perspective, resources in getting Catalytic Capital, which is one of our funding sources that we do provide injection of capital to other venture capital funds that invest in small businesses and minority-owned businesses, really tracking where that investment is so that you can get in front of some of those other funding sources. We provide discoverability opportunities such as our small business badge. We also, of course, provide, when you think about our marketing opportunities and think about the work that SIR does, or I think about the high velocity events or seasonal cultural events like Oprah's Favorite Things. There are opportunities for businesses to get featured, to amplify your innovation. So there's a variety, of different tools and sources and things that we provide. There are new seller incentive credits that we also provide. I'll stop there, but if you go on sell on Amazon,
Yep.
That's where you can find most of our resources.
Love that. So kind of pivoting a bit back to the capital piece, Aaron, question for you. Hypothetically speaking, I raise 6 figures from a fund, or maybe I secure a loan on Amazon Lending. how do I measure the ROI of the funding I receive, or what metrics or mechanisms should we be using to really report that?
How should an entrepreneur measure the ROI of that funding? Well, I guess it depends on where they were with regards to what was the ask of that investment in particular. You'd asked a previous question with regards to how do they think about things around the operational side of things and then the growth side of things. And I think from usually what I end up seeing is a conflation of those two different elements that, I need X capital, and this is going to be fantastic for growth, and they forget that they have to maintain their current status. And if they don't, then they won't be set up for foundational growth. Or vice versa, that whatever they had anticipated ends up being completely eaten up in one way or the other. And the ROI ends up being actually a totally different calculation of how they actually report back to their investors, or how do they think about how to deploy that capital in a meaningful way. And I can tell you, the different partners that you should be thinking of to provide that capital for you, to help you figure out the returns that you want to command with whatever investments that you're asking for from other stakeholders, you should be thinking about it within context of, well, what else outside of the economic returns from this investment am I going to be asking for? You heard Danielle talk about the relationship side of things. What is actually, who's going to be at the table with me at different stages? There's a wonderful saying that Ron Parker, who was the former CEO of the National Association of Securities Professionals, he coined a term called ROR, return on relationships. That's a slightly different take on things in terms of every time you engage with a particular financing source or a different advisor, whatever may be the case, they're going to be bringing their entire Rolodex, their perspective, different things to the table. And so as an individual, before you start talking to Trident, we have 1,000 ISOPs in 50 states. I've got a number of different strategic partners that help engage in so many different fashions. I'm putting all of those things on the table when we're thinking about buying a particular business. So it's not just the $25 million average check that we put on the table, it's the entire Trident network that comes in. And so I would want entrepreneurs to have that perspective in mind, that it's not just the check that I'm asking for, it's that entire ROR.
Yeah, and we know when you say the word check, I feel like I've spoken with hundreds of founders who some have raised, some have bootstrapped. And what I hear so commonly is that they hear 50 no's before they hear that one yes. And hearing the word no can be a really tough pill to swallow, because we're so passionate about our business and we're deeply invested financially in our venture. How can selling partners overcome objections? Like, how do you deal with the word no?
Yeah, so I'm immediately, I have my 11-year-old daughter in my ear, Hartley Rose, who said to me that she actually said to someone else that told me no, she says, my mommy doesn't take no for an answer. No is never final. And as a risk taker, an entrepreneur, we are change agents. How in the world can we operate in the voice of a no? We're only operating in the voice of no to get to the yes. So we're gonna learn from why that no happened, right? But we're gonna move on so that we can get to the yes. Because if we're ruthlessly prioritizing our vision and our mission, there is nothing that is going to stop us from getting to the yes, right? And what I often think about is that yes is stopping me from getting my innovation to impact community and being a part of an economic shift. And when I say no, or when I accept the no, it's something that is bigger. It is allowing me to hold back what my gifts are and my talent and the reason that I created my innovation in order to settle for someone else who doesn't understand. And that's not why we're business owners and entrepreneurs and innovators in this room, is to give our gifts back. So my advice to you is get through the 50 no's. That's your strategy. For capital, I literally, in fundraising, I have a spreadsheet. There is one column that says, here are all the investors that will invest in women-owned companies, investors that will invest in Black-owned companies, that invest in sporting goods, that invest in beauties. It's by category. So I know as I'm going through that list in that spreadsheet or my CRM, I absolutely understand that the majority of those people are not going to be the investors for me. So have the strategy, get through the no's, and then know the yes is coming, because that is your responsibility based on the innovation that you have to get through those no's.
So what I'm hearing is organize your target list and fail fast.
Yes.
Aaron, what advice do you have on overcoming objections? And we have about 30 seconds.
I will say, as a buyout-focused fund, the average private equity firm looks at 50 deals to pull the trigger on one. Now, our methodology and approach, the way we look at things, working with the ISOPs, using technology to differentiate, we actually do about 30 deals before we pull the trigger on one. And what really helps is what we talked about earlier in terms of working with stakeholders that we think have that subsector unfair advantage to success that gives them the ability to ensure that we have a mutually beneficial outcome. We do a lot more with those. And I can tell you, putting yourself in the seat to knock on a door that understands that subsector advantage that you may have will put you in a better position to not have as many no's. Now, Danielle's right. I'll say, as a father of two kids, my son Alex, 17, my daughter 15, Helena, they'll tell you, the number one thing that I kind of drilled into their head, what is failure? And the response that I want them to always recite back to me is, it's just practice until we succeed, Dad. And I think that's what I would want everybody to walk away with.
Yeah.
Powerful stuff. Insightful stuff. Let's summarize what we've talked about today briefly. So, as a roundup, 1, how to calculate the cost of growing your business. 2, the risks to consider when unlocking capital, whether it's external or bootstrapping. 3, the resources available on Amazon. And as a bonus, we talked about how to overcome objections.